The covered call option strategy is a super popular option strategy among long-term stock investors, as the strategy can reduce the loss potential on the shares, can create a stream of income while you wait to sell those shares at a higher price, and it is simple to execute. In this video, I'm going to teach you how the covered call position works by using real option data to simulate historical positions. Let's talk about the strategy's overall characteristics and get a better idea of how it works. The covered call strategy consists of two components. The first component is owning at least 100 shares of stock, and the second component consists of shorting a call option against 100 shares of stock. So when you combine these two positions, which is owning 100 shares of stock, obviously when you own shares of stock, you want the stock price to increase as much as possible, because the further the stock price increases, the more money you're going to make on that stock position. When you short a call option, you are betting against the price increase of the call option. And since a call option's price will increase as the stock price increases, you technically don't want the stock price to increase as much as possible, since a call option will expire worthless if the stock price is below the call's strike price at expiration. So when you combine these two positions of owning 100 shares of stock and betting against a call option, meaning you are shorting the call option and you want its price to go down, what you want is the stock price to increase to the call option strike price, and ideally be right below that call option strike price at expiration, because at that point you will have the most money you can make on the shares of stock and the most money that you can make from the call option without getting assigned on that call option and selling your shares. Before moving on to the specific strategy visuals that I have prepared, let's look at an expiration payoff graph for the covered call position so that you can better understand the pros and cons of this strategy at various stock prices. Let's say I purchase 100 shares of stock for $75 per share, and then I short an 80 strike call option for $300 in premium, and that option has 30 days until expiration. Here is the specific expiration payoff graph for this specific covered call position. The break-even price for this position is 75, which is the stock price that we pay, minus the $3 premium that we collect for selling that call option. So that brings our break-even to $72 at expiration. This means that if the stock price falls to $72, we will have a $300 loss on our stock position, but we will have a $300 profit on that short call position, and those two would offset, and we would have no profits and no losses. As we can see, the covered call position will outperform the stock position at every stock price below the call option strike price, which stems from the premium that we collect for selling that call option. And this highlights how a covered call position will provide a stock investor with more downside protection as compared to simply holding shares of stock without selling call options against them. And with this understanding, here is what a covered call represents. In exchange for better profitability at all stock prices below the short call's strike price, you are giving up your unlimited profit potential above the short call's strike price. So you are essentially selling your upside profit potential on the shares above a certain price in exchange for better profitability at stock prices below that call's strike price. Now let's look at some real option data to simulate covered call positions from the past to visualize exactly how this strategy performs over time. The first example we will look at is when a covered call position does not make as much money as simply holding the shares of stock. Here are the trade details. The stock price at the time of entry is $121.45, so we will buy 100 shares of stock for $121.45. The call option position is going to be shorting the 125 call for $1.41 with 74 days until expiration, which means I collect $141 into my account when I short that call option. Over the first month of this trade, the stock price increased significantly, reaching a price of $133 at approximately 35 days to expiration. With the stock price at $133, the profit on the covered call was around $500, which is approximately the maximum profit potential of this position. The max profit potential of a covered call can be understood from the account inflows and outflows from trades. On the outflow side of the equation, if I buy 100 shares at $121.45, I will pay a total amount of $12,145. On the inflow side of the equation, if I short the 125 call for a price of $1.41, I will collect a total of $141 into my account. If the stock price is above $125 at expiration, I will sell my 100 shares at $125 via short call assignment, and that means I will collect $12,500 for selling my shares at $125 a share. The max profit stems from the outflow of $12,145 plus the total inflows of $12,641, leaving me with a net balance of $496 in profits. Another approach to calculating the max profit is summing the max profit on the stock and short call positions. And the formula you can use is the call strike minus the share purchase price plus the short call credit times 100. So the call strike is 125 and the share purchase price is 121.45, meaning we have a maximum gain of $3.55 per share. Since if I buy 100 shares for 121.45 and I short that 125 call, I am agreeing to sell my shares at a price of $125. The short call credit is $1.41. If we add $3.55 to $1.41, we get a max profit of $4.96 per share. And since we have to multiply this by 100 shares, we get a max profit of $496. In this next example, we're going to look at a scenario where the covered call outperforms simply holding shares of stock, and that's going to be due to the stock price not changing much over the entire trade duration. Here are the trade details. The stock price at the time of entry is $116.45, so we will buy 100 shares of stock at that price. The call option position is shorting the 120 call for $5.80, and that call has 53 days to expiration. And this means that when I sell this call option, I'm going to collect $580 into my account, which will serve as that downside protection and potentially boost my profitability if the stock price remains flat. The focal point here is that the stock price started around $116 and ended around $116, meaning that the stock position itself did not generate a big profit or loss. And since this covered call position was profitable, we know that the profits stemmed from that short call option that we sold for $580 in premium at the beginning of the trade. Since this covered call position ended with a profit of around $580, that stemmed from the call option expiring worthless, and since we shorted that call option, collected $580 in premium for it, and it was worth $0 at expiration, our profit on the short call position of this trade was $580, and our profit and loss on the stock position was around $0, bringing the covered call position's total P&L to around a positive $580. In this next example, we are going to look at a situation where the stock price falls so that we can understand how the covered call position is going to be a more conservative position to have when the stock price is falling as compared to simply holding those 100 shares of stock. In this example, the stock purchase price was around $120 per share, and the trader shorted this 37-day 120 call for $258 in premium. The difference between the stock loss and the covered call loss is the premium collected from the short call, or $260. So this example highlights how a covered call is a safer position than simply holding 100 shares of stock. The max loss potential of a covered call is the amount paid for the shares minus the premium collected from calls. In this example, the share purchase amount is $120 per share times 100 shares, or $12,000. The call premium collected is $258. This brings the max loss on the covered call position to $11,742 because if the stock price goes to zero, I will lose $12,000 on the stock position, but I will profit by $258 on that call position since I shorted the call, and if its price goes to zero, I will profit by the amount of premium collected. So now let's talk about what happens at expiration when trading covered calls. The easiest situation for a covered call is when the stock price is below the call strike at expiration, because if that's the case, then that call option will simply expire worthless. The trader will keep 100% of the premium collected from that short call, and no action is needed to close that call position at the time of expiration. If that call option is out of the money at expiration, it will simply disappear from the trader's account, and then the trader can continue selling a new call option in a further out expiration cycle and different strike price. I should mention that if the stock price is near that call strike price at the time of expiration, it's always a good idea to close that short call, because if you're not paying attention and the stock price does go right above that call strike price at the time of expiration, you will get assigned on that short call and you will effectively sell your 100 shares of stock at that call's strike price. So it's always a good idea to close short options or any at-the-money options before expiration to avoid exercise or assignment. But if the stock price does go slightly above that called strike price at the time of expiration, it doesn't mean that you have a losing trade. For example, if I buy 100 shares of stock for $150 and I short the 160 call option for $5, and at expiration the stock price is at $162, that 160 call option is going to be worth $2, and since I sold it for $5, I will have a $3 profit on that short call. And at the time of expiration, I can simply buy back that short call for $2, secure my $3 profit, continue to hold my shares, and then sell a call option in the next expiration cycle. However, if the stock price goes to $175, then that 160 call option is going to be worth $15. And since I sold it for $5, I will have a $10 loss on that short call position. So in that scenario, if I wanted to continue holding my shares, I would have to buy back that short call for $15 and realize a $10 loss on that call position or that portion of the trade. So it's important to only sell calls against shares that you are willing to sell at a specific price, because when push comes to shove, if the stock price is way above that call strike price at expiration and you do want to keep the shares, the only thing you can do is buy back that short call for a loss, and that is effectively going to increase your share purchase price or your effective purchase price of the shares. And I outlined this in my covered call mistakes video, which I will link in the description below, and you can find at the end of this video. Now that we've covered what happens at expiration, what happens after expiration? Well, assuming you're trading a covered call position and the first trade has been successful and either that call expired worthless or you bought it back for a profit, now you can actually sell a new call option in a further expiration at a different strike price and collect even more premium into your account to keep the covered call strategy going. The ideal scenario when you are trading covered calls is to see the stock price increase, but not increase higher than the short call strike price, because the best case scenario is for the stock price to be slightly below the short call strike price at the time of expiration, which will mean that the call is going to expire out of the money. You are going to realize a 100% profit on that short call portion of the trade. And then you can continue selling calls in subsequent expirations to collect more premium over a long period of time. And this will allow you to create your own income stream on the shares of stock that you own. So let's say you bought 100 shares of stock for $100 per share, paying $10,000 for that stock position. And then for the next 5 months, every 30 days, you shorted a call option against those shares and you collected $500 in premium. Well, if you have 5 consecutive months of fully profitable trades, then you will make $2,500 from those 5 trades. And that will be a very nice profit considering that you entered that stock position for a $10,000 entry price. So this is how covered calls can potentially create a stream of income on shares you own, because if you can successfully sell these call options each month and they expire worthless, then you will continuously make more and more money from those short call positions. And this can be somewhat compared to creating your own dividend stream from the shares of stock that you own. How do you go about choosing a specific call option to sell when you're trading covered calls? Choosing the specific call to sell in a covered call position requires a specific stock price outlook over a specific time period. In terms of the specific time frame, a lot of covered call traders will target that 30 to 60 days to expiration time frame, because shorting longer term options is not as favorable because longer term options do not decay as quickly as more near term options. And on the other side of things, if you go too short term, then you're going to have to sell a call option pretty close to the stock price to collect any amount of decent premium. And that is going to increase the potential for seeing the stock price increase in a week's time or something like that. And then you get assigned on that short call and have to sell your shares. So 30 to 60 days is kind of that sweet spot between collecting premium and being able to select a strike price that is decently out of the money. The amount of premium you can collect for shorting a call option should also be a factor in your strike price selection, because if you can't collect sufficient premium for shorting a call option and giving up all of your upside, then it simply doesn't make sense. So you're capping your profit potential for minimal benefit in that case. So for example, if we look at the 200 call in this example, we can only collect $3 to $4 in total premium for shorting this call option. And therefore, we would be capping all of our upside above $200 for only $3 or $4. Now the stock price is $150, so it would take a significant movement to the upside to even get to $200. But the point is, it wouldn't make sense to make this trade anyways because you are capping your profit potential for minimal benefit. So just make sure that the benefit you can get from shorting a call option makes giving up your upside worth it. If you're shorting calls as more of a defensive trade, then choosing a strike price that is closer to the stock price will give you more downside protection because you will collect more premium. So for example, in this image, the stock price is $150, and we can see that the at the money $150 call expiring in 35 days will collect $620 in premium. That means if we short this call for $620 and it goes to zero, we will make $620 in profits on that short call, which will offset the losses on the stock position if the stock price goes down. But if we short an out of the money call, such as the 180 call, this position is only going to collect $15 in premium, and if it goes to zero, we will only make $15 in profits as opposed to $620 in profits compared to that 150 call. So when you short a further out of the money call, you will collect less premium, and that means you will have less downside protection should the stock price collapse. So now I'm going to actually enter a covered call position so you can see what it looks like to purchase 100 shares of stock and short a call option to successfully enter a covered call position. And then I'm going to wait a few days so that we can see how the covered call position performed and if it made or lost money, and then we'll figure out exactly why that is. The trading platform I'll be using in this demonstration is Tastyworks, which I've been trading with for over 5 years and absolutely love. Specifically in this example, we are going to look at Amazon simply because I like Amazon as a company I want to buy shares of, and currently it's at $90 per share, and it's been significantly beaten down over recent months. So I'm comfortable buying shares and setting up a bullish position in the form of a covered call here. If I were just investing in Amazon, I probably wouldn't do a covered call right now, but I want to enter a covered call position to demonstrate for all of you exactly how this strategy works. So first, I'm going to go over to the trade tab in Tastyworks, and I'm going to do a 4-day covered call position so that we can quickly see how the position performs over the next couple of days. So I'm going to open up the December 16th, 2022 options, and I'm first going to have to buy 100 shares of stock, which I do not already have. So to enter a covered call, I need to buy 100 shares, which I can initiate by clicking on the ask price up top here by Amazon's stock information. And this sets up an order to purchase 100 shares of Amazon stock for $89.55. Now I'm going to go to the 4-day call options. And for this example, I'm going to short the 93 call option simply because it's trading for a little over $100 in total premium. So that kind of makes things nice for an example. So I'm going to go ahead and initiate shorting this call option by clicking on the bid price next to the 93 call expiring in 4 days. So if I click on the bid price, this sets them an order to sell or short this 93 call option, and therefore creating a covered call position. So now we can see down below on the bottom left here, it says we are purchasing 100 shares as a BTO, which means buy to open, and we are selling one of the 93 call options as a sell to open order. And that means I don't have positions in either of these options or shares, and both of these transactions are opening trades. We can also see that the trade price is now $88.45, which is about $1.15 lower than the actual share price of $89.55. So that's because I am collecting premium to short this 93 call, and that effectively reduces my total order price. We can see here that the maximum loss potential is simply the amount I'm going to pay for the shares minus the amount of premium that I will collect for shorting this call option, as we've discussed earlier in this video. The max profit is $455, and that's because if I purchase this covered call position for $88.45 and the stock price goes to above $93 at expiration, then I will have to sell these shares for $93 per share, or that would be the best case scenario if I were to hold this through expiration. And if I buy this covered call position for $88.45 and at expiration, the stock price is above 93, then I will effectively be selling this covered call position for $93. And the difference between 88.45 and 93 is $4.55. But then we have to multiply by 100 to get that max profit of $455. So I'm going to go ahead and see what the mid price is here. It's currently at 88.35. So I'm going to hit review and send, and then I'm going to hit send order. So now we have a working position trying to buy 100 shares of stock and short that 93 call in Amazon that's expiring in 4 days. So here on the positions tab, we are currently looking at the positions that I have open or am trying to open. The mid price here is 88.36, and I have a limit price set to purchase this covered call position for 88.35. So since I'm not getting filled yet, I can replace the order and I can actually increase the order price by 1 or 2 pennies. Let's go to 88.37. I can review and send once more, hit send order, and see how it goes. I'm not filled yet, which means I need to continue increasing my order price or just simply wait to see if the position price comes down to the price that I'm trying to enter this covered call position at. So I can wait here for a little bit, but I'm going to do it once more, replace order, increase the price to 88.41. And what I'm doing is basically trying to get filled at a certain price. And once I'm not getting filled after a certain period of time, I can replace the order and increase the price by a couple pennies. But as we can see, I just got filled on this covered call position at 88.41. So now if I go back to my positions tab, we can see that I have a share position of 100 shares, and I have a short call position, which is shorting the 93 call expiring in 4 days. We know this is a short call position, meaning I'm betting against the call because it says -1 in the quantity section. So I have -1 call options, which means I don't own the call. I am shorting the call, which means I'm betting against its price. So the trade price is the price that I've entered, and the mark is the current market price of the position. So the trade price of the shares is 89.51, and the market price is 89.53. So I have a $1 or $2 profit on the share position. We can see that I shorted the call for $1.10. It's currently trading for $1.10 or 11 cents, and we can see that I'm down $1 on this position. So now I'm going to wait a few days, and then we can see how Amazon stock price changes and how the short call price changes, and we can put those two profits and losses together to see how the overall covered call position performs. Okay, so it's been 2 days since I initially entered that Amazon covered call position. I'm still wearing the same shirt. Let's check in on Amazon to see how it's doing. If you recall, when we entered, the stock price of Amazon was $89.55, and currently Amazon is at $88.23. Today, the market is dumping. The S&P 500 is down over 2%. So Amazon shares are falling, but let's check in on the overall Amazon position to see how things are going. So if we go to the positions tab and we focus on the shares that we own and the 93 short call, we can see how the overall covered call position is doing. As I mentioned, we bought the shares at 89.51 and they're currently at 88.21. So there's a $130 loss on the share position, but we shorted the 93 strike call option that is currently expiring in one more day from now, since tomorrow's Friday. We shorted that option for $1.10. It is currently trading for 5 cents. So we have a $105 profit on the short call portion of this trade. So when we combine these two P&Ls, we're down about $25 to $30 on this overall covered call position, while the share position itself is down $130. So this is an example that is currently highlighting the downside benefit of covered calls, which is that when you short a call option against the shares that you own, you get some downside protection, because if the stock price falls, you'll have a loss on the shares, but you will have a profit on that short call portion of the trade that will offset some of those losses. So since I shorted this 93 strike call for $1.10 and it's currently trading for 5 cents, I can only make another 5 cents on this option. But if something crazy were to happen going into tomorrow and Amazon went to $95 per share or something like that, then this 93 call would be much more valuable in that scenario, and I would actually have to sell my shares at $93 per share if I didn't close the option. So since I've basically made 100% profit on this short call position, I can close this short call position and continue holding the shares, or I can short another call option in a further out expiration. So I'm going to close this short call because I know that's the smart thing to do since I've already made over 90% of the profits on it. There's only $5 more that I can possibly make. So to do that, I'm just going to click on this 93 short call, right click, hit close position, and then this will queue up an order to close this short call position. So I'm going to go and buy back this short call option for 5 cents. And with this price entered, we can see that it says the max profit and max loss is $105. And that's just telling me that if I buy back this option for 5 cents, the platform knows that I initially shorted it for $1.10. So it's just telling me that my profit on this portion of the trade will be $105. So with 5 cents as the price listed, I am going to hit review and send order. And currently I am not yet filled. So I can just sit here and wait and see if I get filled, or I can buy back the option for maybe 6 cents. Since I just want to get out of this, since I don't really care about the 1 or 2 cents, I'm going to replace the order, change the price to 6 cents. And since that is the ask price of this 93 call, I'm basically going to get filled immediately on this trade. So I'm going to hit review and send order, and I just got filled on buying back the 93 call. Now we can see that if I go to the positions tab, my quantity on the 93 call is 0. It is no longer showing any changes in the P&L since I've closed that portion of the trade. Now all that I have left of this covered call position is the stock position, which is initially purchasing the 100 shares for $89.51. You'll see that I do have this other long call option, but that's a separate position for a different video. So for the purposes of this covered call video, we are only concerned with the shares and the short call. If I wanted to short another call in a further out expiration, then I could go to the January 2023 cycle, which has 36 days to go, and I could short another option here. But for now, I think I'm just going to hold the shares since Amazon is getting beaten down. Currently, the market is dumping, and I don't want to continue selling call options into the decline. So I'm just going to hold the shares for now and see how it goes. So hopefully this example was helpful in showing you how a real covered call position performs by seeing how the stock position and the short call position move separately, and how in this instance, the stock price was declining. And although I did lose $130 on the share position from the time we entered the trade 2 days ago, I did make $105 on that short call position, or $104 since I shorted it for $110 in total premium, and I just bought it back for $6 in premium. So I made a profit on the short call, which absorbed most of the loss on the current share loss. So that is an example that highlights how covered calls reduce your downside losses on the shares as compared to simply buying stock and not selling calls against them. Now I want to address some covered call questions that you might have at this point in the video. The first question is, when is the best time to enter a covered call? When the stock price is up or when the stock price is down? The simplest answer is to enter covered calls when you don't anticipate that the stock price is going to appreciate significantly in the near future. Because if that's your outlook, then it doesn't make sense to collect some premium and give up all your upside on the shares, because that's what you are doing with a covered call. Personally, I think it is a good strategy to enter covered calls after the stock price has already ran up, because in that case, you might be anticipating that the stock price is going to trend back down. And in that case, selling a covered call or entering a covered call is going to provide you some protection should the stock price reverse its direction and head downwards. Also, if the opposite happens and the stock price collapses, I don't personally think it's a great strategy to start initiating a covered call when the stock is beaten down, because if the stock price does recover and it rallies strong off the lows, then you are most likely going to have an in-the-money short call at the time of expiration, and you're going to have to sell those shares. So personally, when I'm entering a stock position, or if the stock price has declined significantly in recent history, I am going to be anticipating a recovery in the stock price, and I don't want to get in the way of that stock price recovering by selling covered calls against the shares. The next question is, what if I want to trade covered calls but I don't have a lot of money? Is there an alternative to trading covered calls that I can use? The answer is yes, you can trade the poor man's covered call, which is an alternative to the covered call strategy. And basically, mimics the performance of a covered call position, but it replaces the 100 shares of stock with an in-the-money, longer-term call option. And by doing so, you reduce the amount of money that you need to get into that covered call position, or poor man's covered call position more specifically. The next question is, can you close a covered call position before expiration, or do you have to hold the entire position through expiration? The answer with all option strategies is that you can always close the position before expiration. All you have to do is enter the opposite trades that got you into that trade in the first place. So when you're entering a covered call, you're buying 100 shares and you're shorting a call option. So to close that position, you need to buy back that short call and or sell the shares of stock. But if you're going to do just one, then you can just buy back that short call to close out that short call position, and that will leave you with your 100 shares of stock, which you can do with as you please. The next question is there any way to avoid assignment if the stock price gets above that short call strike price before expiration? The answer is the only way to really avoid it is to close that short call position before expiration, or if it's in the money, because if you do have a short in the money call option, it's not up to you to decide if or when you get assigned, because that decision comes down to the option owner and whether or not they exercise the option. With that being said, if your short call option is just barely in the money and it has a lot of time left until expiration, more than likely it has a lot of extrinsic value remaining. And what that means is it has a low probability of being exercised by the owner, because when you exercise an option, you sacrifice the extrinsic value in that option's price. And that means if an option has a lot of extrinsic value, it doesn't make sense to exercise it. And that means that those options are not going to be exercised by traders who know what they're doing. And that means for you as the short call trader, you will have a low probability of being assigned. So if you want to gauge your early assignment risk with an in-the-money short call, you're going to want to look at the extrinsic value that exists in that short call position. If the extrinsic value is close to zero, then the likelihood of being assigned before expiration is pretty high. But if there is a lot of extrinsic value in that short call option, which is going to be the case if it has lots of time to expiration and isn't super deep in the money, then that's not a situation where you need to be concerned about early assignment.